Welcome back to Squawk Box this morning. Job cuts in Silicon Valley, they are piling up, and Google's parent company, Alphabet, the latest to reduce its headcount, laying off 12,000 workers. Some tech stocks already seeing a bounce this year, with Alphabet up 11%, Amazon and Meta gaining about 16% on the back of it. Here to discuss what the recent cost cuts could mean for tech stocks is Gene Munster, whose Loop Ventures is now Deepwater Asset Management. Good morning to you, Gene. We heard from them. We also heard from Microsoft while they were in Davos having that party with Sting, which turned out to not be such a great look. We were talking about that. And then you got activist investor Elliott Management now this morning in Salesforce's stock. And you can only imagine that that 10% headcount reduction could turn into more. What do you think?
It's going to turn into more, Andrew, highly likely. And just to put some parameters around that, I went back and looked at where we were at the end of 2019 in terms of headcount and looked at all big tech. And most of them have grown at the same pace as their revenue, typically 50 to 80%. The one standout company that hasn't had that growth is Apple in terms of their headcount. They grew revenue 52% over that period, but their headcount was only 19%. And I bring up that as a case study, and I think it will be a guidebook for other tech companies. And ultimately, when you put this together, what it implies is that there's still another 15 to 20% of headcount reductions for these big tech companies in the next 3 to 6 months. And
you think that's across the board? We were talking about Salesforce earlier. So Salesforce had, and the question is, you try to look at what the employment picture was like pre-pandemic. So Salesforce was at 80,000 just a month ago. They're now down to about 71 something, and they were at about 50,000 pre-pandemic. And I don't know if you think that's a good barometer for all of this, but do you say that you got to turn the clock completely backwards?
Not entirely backwards. I think that kind of, let's again use Apple as an example, that 20% benchmark is from where we're at the end of 2019 is a good indicator. Ultimately, is the issue here is that the headcount growth being at the same pace of revenue growth is one piece. The second is that it is just politically impossible to make the proper changes in the speed that these companies need to do it. The one company that has done that, obviously, Twitter, and that has its own.
Let's talk about that, though, because and I will say, in Davos, one of the things that I heard from so many different tech executives was almost a level of awe. Irrespective of what you think about what's happened at Twitter, a level of awe from a management perspective of the willingness to cut as deeply as he has, and a sense that at least thus far it's working, meaning that the service hasn't broken down completely.
That's in part of my belief. I agree. It is impressive. I think it is freeing for some executives to look at what's happened, and he's kind of set that as a plausible approach that you can have significant head cuts. It is, and ultimately, it keeps coming back to simply these companies added too many people too fast. And in Twitter's case, like you said, the business is still going on. In Apple's case, they're still good, cranking out products. They're still growing revenue at a pace that is outpaces what a lot of analysts had thought. So at the end of the day, I think that, again, it's these other companies aren't going to do it. They have a sense of kind of politically how to go about this that Elon Musk doesn't.
Gene, let me just ask, if you have Elliott Management now in its Salesforce, does that give them cover to do things that they would like to do? Does this put pressure on them? Are they unhappy about Elliott coming in? How would you read that?
I think it gives them cover, ultimately probably cover to take a step in the right direction. But even if somebody comes in new, it still is something where you can't go and take that full measure that you need to do. Twitter took more than a full measure, but these other tech companies haven't taken enough. And so,
but Gene, here's the thing that I can't figure out on the Salesforce front, or frankly, many of these other job cuts. You see the big job cut number, and then you see the stock pop marginally. The question really, I think, longer term, especially for these tech stocks, is a multiple story, right? More than just about anything else. And so, how much gain are you going to, from an investor perspective, are you going to get simply from the cut alone? Okay, isn't this a revenue story long term?
So for tech stocks, you need to do both. You need to have stable profitability, preferably growing profit margins, and you still need to be growing. If tech companies aren't growing, they're dying. I mean, it's a simple reality. And for tech investors, they need them both. That's not true for all companies. They need both profitability and revenue growth. In the case of
Gene, if you were going to run a screen, on tech broadly, Would you run a screen looking at the employment figure based on how much, how they grew employment over the last 2 years, 2+ years, pandemic-wise, and then expecting a cut and say, okay, I'll buy that stock? I mean, how would you do this from an investment perspective?
Well, I do want to quickly go back and answer a question that you asked, is the impact here, and just to put Google's recent cuts into perspective, is that their operating margin goes up by 1% with those recent cuts. That assumes a $300,000 average salary per employee. So I think that these, even though they catch a lot of headlines, it really doesn't move the needle. And so when we think about that screen, what's the screen that we're ultimately looking for? We're looking for companies with persistent growth at a right valuation. That's ultimately, that's our investment framework. But that screen in this case is we want to look at companies that have an ability to continue to grow revenue and have headcount is moving in a direction that's up, call it 30% from where it was pre-pandemic.
Gene, before we go, I see you renamed your company. What's the thought?
So that's correct. It's Deepwater Asset Management, and we introduced some new funds and introduced a new brand. And it better reflects who we are, which is we invest both in private and public growth companies driven by tech. And so it's the same team that I've been with for the past 20 years, the core team. We've had some huge additions in the past year. And from my perspective, nothing changes.